Are we live?
Yes.
Okay, great. Good morning, everyone, and welcome to today's joint webinar hosted by ICI New York and Philadelphia chapters. I'm Jay Shah, Vice Chairman of ICI New York chapter, and I'll be moderating today's session on the Indian Union Budget 26-27 and its implications on global businesses and investors. This year's budget comes at a pivotal moment. Global capital flows are shifting, supply chains are recalibrating, and Indian-US economic engagement continues to deepen. Our objective today is very simple. What are the signals embedded in this budget? What are the opportunities? And how should businesses and investors interpret them strategically? It is my distinct honor to introduce our guest of honor, Ambassador Binaya Pradhan, Consul General of India in New York. Ambassador Pradhan is a career diplomat from the 2002 batch of the Indian Foreign Service. Over his distinguished career, he has served in key diplomatic assignments in Moscow, Turkmenistan, and Pakistan. Prior to his current role in New York, he served as High Commissioner of India to Tanzania and permanent representative of the East African Community. During his tenure, India-Tanzania relations were elevated to a strategic partnership, and notably the first overseas campus of IIT Madras was established in Zanzibar. He has also served as Chief of Staff to India's Minister of Petroleum, Natural Gas, and reflecting his strong engagement at the intersection of diplomacy, trade, and economic policy. Ambassador Pradhan's perspective is especially valuable as we evaluate how the Budget 26-27 shapes India's global economic positioning. Ambassador, we are honored to have you with us, and the floor is yours.
Thank you. Thank you, Mr. Shah. Um, Let me begin by conveying my sincere thanks for inviting me to this occasion. Mr. Devang Prajapati, President of the chapter, Mr. Puneet Badia, Mr. Ved Jain from India, thank you for joining from India. Other leaders from both the Philadelphia and New York chapter, members who have joined. Uh, it's every year we after the budget we do an event at the consulate. Last year, in fact, we focused on insurance sector. This year we delayed it a little bit, but this month we are doing quite a few events which should be focusing on this different aspect. But thank you very much for organizing this event, bringing us all together. uh, I'm sure you will be doing a very thorough detailed analysis. You will be having your expert opinion about different aspects. I will focus on 2 3 macro aspects. One, what Mr. Shah mentioned about India-US deepening of economic engagement. Just to give some numbers, today we are talking about $220 billion of bilateral trade. And despite what happened last year, the trade numbers remained quite robust. And this year we foresee the number to have a decent growth. And the interesting part is that we are seeing robust growth both in trade in goods and trade in services. And when it comes to investment, I would say roughly, there is no official statistics, but roughly people who make kind of a summary of that, they find that about $750 billion of US investment has come to India, while the foreign direct investment element looks a smaller portion, which is in the range of 70 to $72 billion. But when you bring in the amount of money that is coming through venture and alternate capital that is coming through our stock market, it's a very, very decent amount of investment. But I'm particularly bullish about the GCCs that is opening in India today. As you would see, out of about 1,900 global capability centers, about 1,000 plus 1,050, 1,060 are American GCCs, and they are the big ones. And that number is going to go up. Today, we have only one third of the Fortune 500 companies having GCCs in India. I'm sure in next 3 to 4 years, we'll be having the remaining of them having their GCCs in India. So in that kind of a gigantic, economic engagement, very active economic corridor, having the conference like this, bringing in the chartered accountants to the conversation is very important. I personally believe that you play a special role in our economy. You are kind of guardians of transparency, facilitators of enterprise, and enablers of compliance and good governance. And in India-US context, I have been here for last 2 years. I have seen that you play an important role, whether it is investment or whether it is trade. Before coming here, when I was in Tanzania, we have a very active chapter of ICAI there. They work very closely with the government. They bring in ministers and important regulators to their conference. And I personally, as ambassador of India, benefited with my association there. So when I say it, I really mean that we really look forward to work with you. But coming to the budget, I would focus on three, four areas that I see as important. One is that the budgets focus on our macroeconomic fundamentals and kind of trying to provide a predictability about investment decisions, which is important for the global investors and the business leaders. So I'm sure this budget is going to reinforce confidence in them. Number two is about the continued push on infrastructure. People here in the United States, most of you are staying here. You would see that there is kind of an appreciation about the investment that India is doing in both physical infrastructure and social infrastructure. And this budget is kind of going ahead on that. And it's not only building road and rail, but it's providing kind of backbone of modern economy, whether it is logistics, urban infrastructure, whether it is digital integration, clean energy transition. So all the modern infrastructure building has remained a focus of this budget. Number three, I would say, is strengthening the service sector, and that is an area of importance for me. And I would going forward request your support on that. Uh, as you see that now we are saying that we want to be 10% of the global service sector share by 2047. So there is a kind of focus on that. You should see the global capability centers, the trade in services in that context. Number four is financial services, and that is again an area where you come in a major way. And I think to tap the potential of this sector, this tax holiday for offshore banking units and units in IFSC is expanded this time, and minimum alternate tax rates are reduced. But for ICI members and your networks here, I would request that you should while you are doing your own thing, you should think of ways that we work together, both in New York and other consulates and Washington D.C. on two areas. One is new investment. I mentioned about the investment tracks. In fact, on 12th of this month, we are hosting about 100 plus family offices of United States in the consulate. By end of this month, we are hosting 26, 27. We are hosting the Gift City authorities. The chairman of Gift City and their whole team is coming for attracting investment and attracting universities. Next month we are hosting, because the finance minister would be in the country, so we are hosting very important meetings during the IMF World Bank time, because that is a time when you get the SEBI, you get the RBI, all the leaders of both regulatory organizations and the finance minister, all of them are here. We are trying to organize few other investment meetings, but that is one area where we want to work with you. And the second area is trade in services. As you know, India is growing very fast in trade in services with the United States. Our export is in the tune of about $45 billion. But the projection is that when we talk about Mission 500, when we talk about expanding our bilateral trade to $500 billion by 2030, I see major growth happening in service sector. And you form a major pillar in that. Last year, we did one or two events, and I remember receiving the Surat ICAI chapter, receiving two, three other chapters of ICAI from India in the consulate. And I know that you have very strong linkages with CPA firms here. They outsource bulk of their work to India. They have a very strong linkage. So that is one area, Mr. Jain, we need your help from India to connect people who provide such services, people who are integrated here. And I need friends from here to help us to kind of strengthening that link so that we increase our export in trade in services, particularly in accounting. We are also working with the legal groups to expand that. We are also working with the medical fraternity on that. But these are areas of trade in services where we need your support. Now, coming to my specific request, uh, this month we are launching a trade portal. We are calling it India-US Trade Facilitation Portal. My colleague Rajlakshmi is the architect of that. She is working with a group. We have given them a contract. So by 10th of March, we are going to onboard the exporters from India, both in goods and services, and importers from US, both from goods and services sector. And on 21st of this month, we are launching that portal. We are going public. We have done quite a few stakeholders consultations, mostly with trade in goods. So all the Indian export promotion councils, chambers, we have done stakeholding events with them, so that from 10th March, we will take them on board, register them in our portal, which is a simple process. But coming to trade in services, it looks, rather unconventional. Even we as a government, we struggle as to how we do it. So that is one area where we need your help, both from India and from here. And while today's focus is on the budget, I would request after the event, if you can give a point of contact so that my colleague Raj Lakshmi can work, and we strengthen our portal on this element as well, on the trade in services, particularly on accounting side. But let me thank you once again for doing this important event, and we look forward to listen to your ideas, your analysis. Thank you once again.
Ambassador, thank you so much again for your time and valuable insights. Those remarks are setting the broader macroeconomic context for our webinar. And now we'll move to a more detailed fiscal tax and policy analysis of budget 2026-27. It is now my privilege to introduce our featured speaker, CA Ved Jain. CA Ved Jain is a past president of the Institute of Chartered Accountants of India and one of the most respected voices in India's tax and fiscal ecosystem. With decades of experience in direct tax and policy advisory, he brings exceptional clarity to complex legislative developments. CA Ved, we look forward to your deep dive into the fiscal, tax, and policy dimensions of Budget 26-27. Over to you.
Thank you, Mr. Shah. Honorable Consul General, Mr. Pradhan, Chairman of the New York chapter, Mr. Devang Prajapati, Mr. Puneet, Mr. Jay Shah, of course, CGI Raj Lakshmi ji, and all my professional colleagues from New York and other parts of the world. It's my privilege to be invited to deliver a talk and deliberate upon the budget 2026. I have the very pleasant and fond memories way back in the year 2008, when this chapter New York was inaugurated at a place none other than in the office of the Consul General only. I had come there as president, and it was at that time there was no formal office or formal working. It was only in the office of the Consul General that inauguration has taken place of this chapter. So when I got an invitation from the chairman this time, I said no. I could not say no, because I said yes, New York is very close to me, though distance-wise it may be too far, but still very close to me, and that's why I have the fond memories of that issue. And I'm very happy to see that on this weekend, Sunday morning, so many members are interested in getting the nitty-gritties of the India budget 2026, despite being in US, the largest economy of the world, and still being interested of the home country, India, literally. And this budget, as 2026 1st February, was in the context, is a very complex scenario in that context. So many uncertainty was there with the finance minister. And before the budget came, I was always wondering, even when you are going to make the best of estimate, you still need to make certain assumptions that what is going to happen and how it is going to happen. We all chartered accountant know that budget, though may be a balancing exercise, income and expenditure, but at the same time, you have to give a shape, you have to give a vision, you have to give a direction and course correction over the period, what has happened to the country. And this is the time when you review what your performance has been in the last year and what you expect in the future. And this time on 1st February 2026, I believe nothing can be more uncertain. I think the day this was. The day itself was uncertain, because that happened to be a Sunday. On that day, whether the budget would be presented or not, there was a lot of suspense on that part. And we all speakers were also in dilemma, whether it will be first or second, how it is. That suspense was there. Then, of course, the geopolitical situations, Ukraine, Russia war, and then Hamas, Israel, those issues going on, other issues going on, and of course, tariff, India-US tariff suspense at that time was not clear. So that numbers were there. In that background, the finance minister has only the data of what Indian financial performance has been in the financial year 2025 and 26. And in that scenario, I will say she made a very bold and I think enthusiastic attempt and has given the budget, which I believe, though it cannot satisfy everybody, is one of the best budget in the scenario. People do ask me, because here in India, when people talk about what I have got in the budget, I should get something out of it. The finance minister's job is to provide something to everyone concerned. As you see the budget part A, as we read it out, she start from A, B, C, D, and all sectors are covered on that issue. But only one agenda is in her mind: economic growth that will bring prosperity to the country, and fiscal discipline that will ensure confidence in the country, infrastructure development that will promote industries and will create more job and more employment. That's a major agenda of this issue. And this 1st February was again proved to be momentous and action-packed for India. And when we look at the budget, we see more than just numbers. We see a structural shift in India-US relationship. The budget focused on the from complex compliance to ease of investing and trust-based governance. The Union Budget 2026 outlines a clear roadmap for sustained growth, combining reform-led expansion with fiscal prudence, with continued focus on capital expenditure and welfare priorities. It provides policy for taxpayers, businesses, and investors. While headlines might focus on diplomacy, the economic plumbing has never been stronger. India's fiscal deficit is shrinking to 4.3. If you look at the just number of fiscal deficit, it was projected to be 4.5 for the financial year 2025-26, but we are going to end up with a 4.4. Next year, it is going to be projected at 4.3. We all know that fiscal deficit is a salt, which you need good for the economic growth. You need a pinch of it, but excess of this can make a bitter taste. At the same time, the shortness of this smallness can also create a problem. Economic growth will get on. That way, I think hats off to the finance minister, the way she has handled both the scenario, growth and expenditure, at the same time managing the fiscal deficit alternating. As market responded to the Union Budget 2026 with cautious optimism, policymakers, analysts, and industry leaders closely examined the fine print of the government growth-oriented roadmap. The spotlight was firmly on the Economic Survey 2025-26 and the Union Budget to 2026-27, which together outline the vision for the sustained economic expansion, fiscal discipline, and structural reform aimed at strengthening India's position as a resilient and forward-looking economy. I would just like to just share my slide now on this number. Okay. Can you see the slide, please?
Yes.
Shah?
Yes.
Is it clear?
It's clear.
Yeah. Look at this slide. How India's GDP growth has been. We have been growing at 8%, 6%, then 4% because this period is the COVID period. When we see the red period, financial year 20 to 22, and then next year because the growth had dipped, so next year was supposed to be quite heavy, this 9.7%, and then 9.2, and now here we are again going to be 7% plus. This is our what we call the GDP, one of the best GDP, the highest GDP growth of any country globally on that issue. Even the China will be, I think, somewhere less than 5%, or of course, America is 3% somewhere like this is, and global GDP growth numbers are far less than on that issue. The stated target is further. Now, one thing which I talked about of this fiscal deficit, which we say 4.3% is projected, but the second factor which is to be taken into consideration is your debt GDP ratio, which is now projected to be 56.1%. And the commitment is that we will bring it down in next year to 55.6%. And the road ahead that it has to be somewhere 50%, 1% plus minus. So these are the something which is, I think, fiscal discipline, which will inspire more confidence in India's economy and India's investment on this point. And on top of it, if you look at these numbers, we have an all-time high of the foreign exchange reserve, 720 plus billion dollars of the reserve. This massive war chest provides high stability against global currency fluctuation and robust import cover over 11 months. I will be talking later on, time permitting, about some concern being raised about the India rupee dollar rate, but this foreign exchange reserve itself demonstrates the confidence in the Indian economy on that issue. The remittance, India continues to be remittance kings, and we got $135 billion of the remittance on that issue. India has been able to manage its current account deficit despite all headwinds, I will say, particularly in the last year, financial year 25 in the year. It has narrowed down to 0.8% of GDP as against 1.3 on this issue. Even the current year figures which are being indicated are quite positive. So this shows how the economy has performed on this part, on this issue. And now this is the growth of the foreign exchange. If you see 2014-15, we have got $300 plus billion, and now it is $700 plus billion, and how it progressively we are going. And this is a continuous indication of a continuous confidence in the investment in India on that part. Now, this is a snapshot of what India's fiscal, I will say. The real GDP growth is estimated at 7.4% for financial year 25-26. And now nominal GDP is expected to be more than 10%. Inflation, which used to be the major factor of for a developing nation, that in case inflation is high, despite economic growth, the real growth will be lower because you have to discount it by the inflation. But India, you see the last quarter, it has been 1.7%. Fiscal deficit, I already talked about, at 4.3%. Public expenditure, the capital expenditure in the budget has been proposed quite substantially high. In the budget 2024, it was 10 lakh crore. It was increased to 25 with 11 lakh crore, and now it is being increased to 12.22 lakh crore, which is 4.4% of the GDP. This shows how the government is planning and looking to the development of infrastructures. Now, India's exports has also recorded $825 billion. As the Honorable Consul General was talking about, that the US trade also has been quite good despite little bit headwinds in the financial year 25-26. Foreign exchange reserve, of course, have been good. Agriculture and allied services are also estimated to grow by 3.1%. Industrial sector is going to grow by 6%. So there are strong tailwinds for India to push the economy forward on that part. Now, when we look at this GDP numbers, I will be talking about this GDP growth later part, how we have been performing and what India's vision is. But this slide just to show that India has been growing very fast in the last 5 years. And in the year 2025, we have crossed Japan and become the third largest economy. And the way the picture is being projected, by 2028, India will cross this Germany also, and we will be the third largest economy, or the way our GDP is growing on that part. Now, this is the slide we just want to spend a few minutes on that part. If you just look at this, because this is just to give how India, China, and US has performed over a period. In 1980, the total world economy was $11.23 trillion. US economy was $2.85 trillion. China's economy was just $195 billion. India was $186 billion. And per capita income, China was 309, India was 277. In 1990, now Chinese economy went from $191 billion to 360. India went from 186 to 320. but the per capita income of India in 1990 was far more than the China's 344 to 371. This is the good number, one number. And over a period, now Chinese economy has grown from $191 billion from 1980 to $19.25 trillion. Now it is in trillion dollars. And whereas we have gone from $1.186 billion to $4.3 trillion now on this issue. Now, this number indicates the way India's economy is growing. What will be the scenario in the years to come? Presently, our per capita GDP is 2,934 as against China's 13,657. And if I look at the next slide on that part, now this will be the scenario which I'm projecting, looking at the projected on this issue. Now this is in 2025, as I said, this is the number, and 2047 when we are talking about the Viksit Bharat, this number, the world economy will be $190 trillion, US will be $38 trillion plus, China will be $45 trillion plus, India will be $35 trillion plus. That's the next 22 years, India's growth is going to be that way. And if that is going to be there, India's per capita GDP is going to be 21,000 US dollars. And by 2075, also I have to try to project it, but later on I will talk on the issue. I will come back, time permitting, on this slide again on that issue. Now, another factor which is very important to consider is when we are talking of the budget is also how this economy is to be measured, that your growth is real growth in the economy. I, as a chartered accountant, believe tax is one of the major, I think, barometer to confirm that whatever you are saying about the growth of the economy is the real growth in the economy. If the tax collections are going up, obviously means people are making more money, economy is moving forward, and that's why tax collections have gone up on that issue. I would just like to show you this slide, which is just maybe a mind opening on the past history. Look at 1991. The total income tax collection was 6,900 crore, as 7,000 crore rupees on the issue. As against this, now 25-26, the total collection is 24,21,000 crore rupees. Just look how Indian economy has moved forward. 7,000 crore rupees in 1991, and now we are 24,21,000 crore rupees only. And this is the overall budget, which I need not spend much time on that issue, but this is an area just to indicate that how the economy is projecting. And in line with that, I just try to project what will be the India's income tax collections in the year 2046 to 47, when will completing 100 years of our independence, what we call Viksit Bharat. Now, if I apply the same factor which has applied from 2010 to 2025, this 4 lakh has become 6 times almost. You can say it. So 24 by 6 times will be 169 lakh crore. That will be the income tax collection. And if that be the income tax collection and money coming in, you can look into that infrastructure development, the money available with the government, and the way the things will be moving forward. That's an indication on that part. Now, in this scenario, now I just take you what this budget contains for us. Now, this budget, when was presented on 1st February 2026. Before that, 3 things have happened important. We carried out in 2025, after the Prime Minister Narendra Modi ji announcement on the 15th August, in September, comprehensive GST simplification. 2, notification of labor codes and mandatory quality control orders we were announced. And now, thereafter, in this budget, the Honorable Finance Minister has identified 7 prime area of scaling up the manufacturing. And why manufacturing? Because now, as we see, the Indian GDP major contributor is the service sector, but employment generation and for sustainability, and when we are talking of China +1, manufacturing sector has to be promoted. And that's why the Honorable Finance Minister focus in this budget was on the manufacturing. And for scaling up manufacturing, she has identified biopharma as one of the major areas. And what she says in the budget is very important to notice it, that now it is not the communicable diseases like earlier used to be. India is concerned about the other diseases and biology that can play a very active part. And that's why she said we need to spend time or money and time on this biopharma. Semiconductor, as we know, has become a challenge on that part, the way the demand has grown up. So India has announced India's semiconductor mission. Third is the electronic component manufacturing scheme, dedicated rare earth corridors, dedicated chemical parts, high-tech tools and infrastructure equipment, and container manufacturing. I will be talking to you just on this part in this issue. Now, this budget highlights effective now this 12.2 lakh crore, which is projected for capital expenditure on all these areas: scale and durability, supply chain upside, and inflation hedge. Now, these are the major areas which is going to be addressed on this part. And when we talk of this capital expenditure, now the railways and highways, a lot of money is going to be spent to reduce the logistic cost so that India becomes more competitive as compared to the other parts of the world. Shipbuilding has been according to infrastructure status with a substantial amount of a revival package. Similarly, semiconductor 40,000 crore rupees has been allocated, and biopharma Shakti at 10,000 crore rupees has been allocated for that part on. These are the five, I think, major projects which have been announced: semiconductor missions, several high-speed corridors, 7 high-speed rail corridors have been announced, and for SME, MSME growth to improve liquidity and scale, so 10,000 crore rupees has been returned. My fellow chartered accountant probably may be aware that the Honorable Finance Minister in her budget speech did speak about the Institute of Chartered Accountant of India to come out with a scheme of MET3. And MET3 means that in Tier 2 and Tier 3 city, a chartered accountant should come out and help out the MSME sector by training those people who can provide compliance services to MSME sector on that part also. Now, 20 new national waterways, inland waterways have been planned, and capacity building for AI mission has been announced for that part of the issue. Having talked about these certain economic issues, now let me just switch over to some regulatory taxation issues. One major area is how to attract investment and how to liberalize the economy. And one landmark announcement in the budget is direct access for persons resident outside India to invest directly in listed Indian companies under the portfolio investment scheme. Now, this was a major challenge that this how to allow this on this issue. So a concession has been worked out for individual now, raising this limit from 5% to 10% per company. Now, an individual itself can make an investment up to 10% as a portfolio investment. Earlier, it was only 5%. And in a company collectively, it can be 24%. Now, what you will be thinking, what will happen? How does it make a change? Now, this change helps in larger strategic stakes. If NRIs and PROIs can deploy meaningful capital into mid-cap and high-growth sector, enabling concentrated portfolio position rather than passive allocation. Because when you are holding 10% and 24%, you have a larger strategic stakes. You have active engagement and governance influence, higher permissible exposure, facilitate informed shareholder participation, strong governance, alignment, and value accrual and engagement with management. And it increases patient capital in manufacturing, technology, infrastructure, and emerging. I believe we all chartered accountants, particularly yourself being located in one of the, I think, largest economy of the world, in US, you can be the real game changer in attracting investment for India and asking people that, yes, you can make investment in India. And later on, I will just tell you, the Honorable Consul General did talk about it, how this Gift City International Financial Service Center can provide you a cushion and can provide you a convenient way, and also without any extra risk, this facility on that issue. Now, this equity market, as I said, to 5 to 10% to 10 to 24%. Now, presently, NRI hold roughly less than 1% of the NSE listed companies. Now, this ceiling has been increased from 10% to 24%, 5 to 10%. So there is a major headway now available, and I believe something can be done on that part also. Similarly, there is a now a bond market. So Honorable Finance Minister has announced that to total return swap on corporate bond, providing better hedging and entry point over overseas also. In line with these, some changes which have been announced on regulatory parts, there are few changes which may be of interest in the indirect taxes also. Now, customs advance ruling now will be valid for 5 years. So people who are exporting from the various part of the world, including US, now in case those importers from the where get a advance ruling on custom, now that will be valid for 5 years, which will be supply chain predictability. But there will be no suspense at what cost it will land to India, because you are very clear on that part as well. So 90% provisional GST refund for inverted duty structure, that has also been flown over. And there has been a massive duty exemptions on various items, particularly critical minerals, electronic parts, and renewable energy components. So there is a 0% basic custom duty on 25 critical minerals, which can also lithium, copper, cobalt, can be a big game changer and can help people who are outside, they want to import in India, that can help it out also. Now, coming to some direct tax proposals on this parts. Firstly, people do ask me whether there is any concession in the direct tax. I say we have carried out massive reform in the direct tax. First in 2024, when the capital gain tax structure was completely overhauled, and in the 2025, giving a massive change and benefit to the middle class by exempting income up to rupees 12 lakh. Of course, I know that non-resident Indians are not entitled to that benefit, but all resident Indians are entitled to that benefit of that school. And then the tax rate, of course, up to 4 lakhs, no tax 4 to 8, 5%, 8 to 10, 12, 10%, and 12 to 16, 15%. That's a basic rate. This year, there is no change in the tax rate, but the major change are three in the tax rate, which may be one of a major, may be relevant. Now, MAT rate has been reduced from 15% to 14% on that part. There was another small tax the issue, which I probably as a non-resident, interest may not be there, that in case of a cash credit to certain other income, the tax rate used to be 60%, which has been brought down to 30%. The third change which has been brought is the buyback of the share. Now, earlier it was being treated as a dividend income, which was introduced in 2024. But now again, a rethinking has taken place, and now again it will be considered to be only a capital gain, depending on the issue. Now, concession which may be relevant for all of you as a non-resident is one major concession and relief announced in this budget is about the data center. As the Honorable Consul General was talking about, India is looking to the setting up of the large GCC. We are looking to the setting up of GCC. India is the best choice for people to set up for corporate to set up a GCC in India. Now, in line with that, data center, India is promoting like anything. And in that regard, this budget has promised that whichever foreign company, this exemption is available only to a foreign company. Whichever foreign companies set up a data center here in India, now that facility of using the data center by that foreign company from India will not be taxable till 2047. It's a commitment for next more than 20 years that income will be exempt. But we need to be very clear what this exemption is. This exemption is not in relation to the services provided to Indian company or provided by a foreign company to an Indian company. This is only by using the services of the data center was by the foreign company. So exemption will be to a foreign company only and nobody else on that part on this issue. Now, another exemption which has been given is cross-border supply of capital goods to contract manufacturer. Now, India, as I said, want to promote manufacturing in a large way in India. And one of the way is that you allowed contract manufacturers to use the machineries, equipment, and tools of the person or the corporate for whom they are manufacturing this. Now, this budget says, yes, in case the capital goods are received by a contract manufacturer from outside India, the ownership continues with that person who has supplied the goods fund company, and contract manufacturing takes place in India in the bonded warehouse. Now, the income of that corporate or foreign company which has supplied that good will not be taxable in India. That's a message which has been given on that part on this issue. Previously, such arrangement used to be liable to tax because we have a provision where we say income deemed to have accrued in India in respect of the goods or equipment used by tools used by the Indian, and that way certain income would have accrued. So now that has been taken away. Now there is another exemption which has been provided. This is, I think, rare is it had exemption for first time non-resident. Now government under certain scheme, they notified if a person has been a non-resident in the preceding 5 years and comes to India for next 5 years for providing his services in respect of the certain scheme notified by the government, then his income in India will be chargeable to tax only, but the foreign income outside India will not be chargeable to tax. Now, this will avoid duplicity. I do agree that as being the US citizen or US resident, in any case, if somebody comes from US to India, his income may not be taxable in India, but he earns in US, but in US it will get taxed. But being a resident, India will have taken a tax by consolidating, by merging both the income. Now this is for a particular 5 years, if you come back, that will not be income on that, not with this issue. Now, another important is ease of doing business, which is we say, and many multinational companies were having a challenge with Indian tax authorities. Now, this budget offers very, I will say, a large scale concession. If I say that this budget is really a budget where the government and the tax authorities want to bridge the trust deficit between the taxpayer and the tax administration. First, I will just talk to you about the multinational and then some other provision which may be applicable in your case also. Now, advance pricing agreement which is done. Now, the present law says that on the basis of advance price agreement, price APA, which we call it, the benefit is available only to the applicant. But now this budget says no, because there is an associated enterprises with you, the benefit will also be available to your other counterpart. So if an Indian company takes a APA, goes for APA in respect of the certain related party transaction, transfer pricing transaction with the US company, then US company can also claim the benefit of this also on this issue. Then there is another change is, as I say, ease of doing business. Now, presently, a lot of time is being taken for processing this advance pricing agreement. Now, the government has fast tracked within 2 years with an additional 6 months at the option of the person who's an applicant. Similarly, in IT sector, there has been a lot of disputes on tax issues. Now, on that part also, a relaxation has been made it out. All services of IT related, whether it is software development, research, development, KPO, BPO, they will all be considered as IT services, and safe harbor 15.5% will be applicable. And eligibility to opt for safe harbor is being increased for a company having a turnover up to from 300 crore to 2,000 crore rupees. So this is again a big concession which is being announced on that part. Now this I have talked about this one company on this part. Now these are some concessions relating to the gift city and the SEZ. Now if I talk about the gift city, now there is a extended tax holiday now announced. As you all know, we have International Financial Services Center, which India is trying to make it out an alternative financial capital of the world. And in that process, a lot of exemption and benefits are available. People who want to do business, who want to invest through that International Financial Services Center. Presently, those units which are operating in GIFT City, income is exempt out of for 10 years out of the 15 years. Now, this period is being extended to 20 years out of the 25 years to give a longer sustainability. Thereafter, also the income will be chargeable to tax at the rate of 15% only, not as against 22%, 25%. So this is again a complication. Third benefit of GIFT City is, as I talked about earlier, that whatever you are investing, you're investing in foreign currency. So you get a shield against the rupee depreciation. So whatever the money you invest in the International Service Center, that will be in the currency in which you want. If you want to invest in US dollar, so you will have the benefit of this issue. Another concession has been announced that those funds who want to transfer from one place to GIFT City, now there will be no tax on relocation of the profit on that issue on that part. So these are the some benefit which has been given of the International Financial Services Center. An idea how this International Financial Service Center can be helpful is, in case you have an income of 8% pre-tax, then post-tax, the return will go down because then you have to pay the tax and it will go down. But in case you are in GIFT City for first 20 years, 8% will mean post-tax is also 8%. And thereafter also after 25 years, then your income will be taxed at 15%, still you will be benefit. This slide shows that how you are benefited by the GIFT City on this part. Now, India has provided one option is GIFT City, where you get a complete exemption. Then you have a SCZ also, where you can have a exemption like this on this part. Now, as a non-resident, I believe one of the questions you may mind may be because that Indian rupee getting depreciated. But if you make investment in a bank in an international financial service center or otherwise, your money is safe because you can keep the money in the dollar and your money doesn't get depreciated on that part on this part. Now, India's strategic buffer. New for 2020, expanded US dollar denominated fixed deposit. NRI can now place deposit in US dollar with GIFT City branch and earn interest that is completely tax-free in India. You get India level interest 5 to 6% in US dollar without even converting to rupee, completely bypassing the depreciation risk we discussed. To address the black swan, which we say USA Iran hanging cloud event of early 2026, India has used 2026 as a defensive and offensive shield against the global volatility. Now, this is a summary which I believe is overall benefit which is coming it out. One benefit which I would just like to talk about is that India in this budget has announced 3-4 administrative changes which may be relevant for you in the purpose. One is this: when you, as a non-resident, you have to sell a property in India, the buyer being a resident, he was required to obtain a TIN number. Now the law is being amended from 1st October 2026 that in case the seller is a non-resident, then the buyer need not obtain the TIN number, which was a complicated issue and that has been issued. Second exemption which has been given, important maybe, which is it under section 197, there is a clause to obtain a lower deduction certificate. Earlier, it was a complex process that you have to make an application to the assessing officer, submit document and convince him. Now this will be online. This being an online, I will suggest many of my friends, non-resident, there may be small bank account in India or some income in India on which tax get deducted at a higher rate. Probably you may be aware that on saving bank interest also 30% tax is deducted. though your income may not be chargeable to tax because you do not have an income more than 2,50,000 or 4 lakh rupees, as the case may be. But still, you may be required the TDS get deducted, and getting a refund may be a cumbersome process. Now, I will suggest that with the amendment in 197, now you can make an online application to ensure that no tax is deducted by bank or tax is deducted at a lower rate, which should be the effective tax rate on that part, on this part. Thank you. This is all we're talking about simplified automatic lower deduction certificate process, where we are looking forward on that part on this issue. Now, there are certain exemptions which have been given in respect of the TCS. I would just like to go to this slide back on this issue. Now, as you earlier know that in case under liberalized rehabilitation scheme, a resident is allowed to withdraw the foreign currency up to $250,000, but then there was a tax collection at source which goes up to 20% on that basis. Now, this budget has rationalized the TCS provision by and large to 2% in all cases. This will give a big relief for travels, particularly your relative, etc., which want to travel, etc., and to withdraw foreign exchange. So this benefit will be available. An idea of this concession can be had from this slide, where this amount gets 2% as against 20%, what the benefit likely coming out on that part on this issue. Friends, I just talked about this budget, various provision on that issues. Some procedural part, I can touch it about is, one is tax filing, which may be relevant for you. One is the due date of filing tax return in your case, since you do not carry on any business in India, will continue to be 31st July 1. But you will be entitled to revise the return up to 31st March as against 31st December. Thirdly, now you are entitled to file an updated return also in case you have committed any mistake earlier by paying an under taxes. Another area, most important area pointed to you will be about this challenge which has come to many non-resident, which happen to be non-resident at one point of time and have come back to India some point of time, and they were having ESOP or some dividend income or an account lying in foreign bank account. And unfortunately, income or the source has not been declared in their tax returns, or the income has been declared, but particulars have not been submitted in tax returns. Under the black money law, this is considered to be a very serious offense. Now, this budget has proposed a scheme which we call an amnesty scheme, probably which will be valid for 6 months and open on 1st April 2026, which will give an option that in case you have forgotten to report any foreign income or foreign assets, which as a resident you are supposed to. If you are a non-resident, then you are not supposed to. But if you happen to be a resident, you are supposed to. Now, this scheme will allow you to get out of that trouble by paying 30% tax and 30% extra penalty on that part. In case income has been declared and the source is genuine, but unfortunately the particulars have not been uploaded on the income tax return, then amnesty scheme will still be applicable. By just paying 1 lakh rupees, you can get out of on that issues. Right? These are the issue which we talked about it, but there may be certain issues which I believe maybe to your mind. I just thought about it that time permitting, I can take it out. Buyback, I don't want sovereign gold bonds. As you know that this benefit will be available only when you are original subscriber and you are submitting it at the time of the redemption also. It should be both primary owner and continues to be children. This amnesty scheme which I talked about, this is a employment scheme on this issue. Now, as I say, this budget is at large administrative reform. All those provisions of income tax which carry very heavy penalty and which carry imprisonment, they have all been diluted now. Under the Income Tax Act, now the benefit has been given that at any point of time, if you realize your mistake and you are ready to pay extra tax, then that mistake can be corrected by paying taxes. Similarly, for prosecution, it will be some simple imprisonment depending upon the offense which has been created, which is I believe, a good, as India is progressing towards to become what we call a developed economy. The law is being amended in line with that part only on that issue. And as we all know that the new Income Tax Act is going to come into force from 1st April 2026, which is going to be a trust-based. All, I think, predictability, compliance, all has been done easier on that part on this issue. This part, I think time is not there. I can skip it out about this India-US trade deal, which has been there. And in case there are a few questions, I will take it that also. Now, few questions, few points which I just noted down that which may be your wish list, but it's still an unfinished agenda. TDS parity with resident Indians. NRIs wanted the removal of the highest TDS rate of 30% on bank interest and rental income, particularly saving bank interest also. Similarly, capital gain versus basic exemption limit, which is available to a resident, is not available to a non-resident. I believe that may be that's a larger issue which is there. Investment in small savings scheme, public provident fund, senior citizen scheme, etc. These are not open to the non-resident. I believe that has been a lot of, I think, push from the non-resident that this should also be open to the non-resident Indians also. And similarly, some exemption which are available to a resident is not available to a non-resident regarding the home loan on that part on the issue. Friend, these are some of the areas which I want to discuss. I can just leave the house now and go back to Mr. Shah and Mr. Prajapati and Mr. Puneet. If you have questions, so we can go ahead and take few questions on that issue.
CA Ved Jain, thank you so much for that comprehensive and insightful analysis. For myself personally, as a professional who moved here and is a non-resident in India, it's very exciting that I can invest back in India without dollar depreciation. But to build on those insights, we now move into our strategic discussion. Joining us is CA Devang Prajapati, who is the chairman of the ICI New York chapter and a seasoned chartered accountant and a US CPA with over 22 years of experience specializing in cross-border India-US tax strategy. And we have CA Puneet Baradia, who is a board member of ICI Philadelphia and finance manager at Acrotech Biopharma with strong expertise in FP&A, strategic budgeting, forecasting, and operational finance across multinationals. Gentlemen, welcome.
Thank you, Jay. Thank you. And thank you, Mr. Ved Jain. This is really insightful session. And there are a few questions that we want to discuss which help remember because it is more relevant for them because they want to invest in India at the same time they want to do this tax strategy from a global perspective where they can create a tax efficiency at a global level. So they also invest a lot of time in Indian real estate. So the first question that I have is, what are the income tax rates and TDS on capital gains from the sale of real estate and the rental income? Is there any relief in terms of compliance for the investment in real estate by US investors?
I say there is no specific relief to answer the last question first for US investors. But capital gain across the board for resident and non-resident is one and the same. If it is a long-term capital gain, it is 12.5% plus applicable surcharge, whatever it is, comes to roughly 40.9%. And if it is a short-term capital gain, then it is a normal rate. But if the short-term capital gain is arising from the listed securities and which the transaction has happened on the exchange, then the rate will be 20%. So, and this is across the board. Similarly, for a rental income, so tax rate is same what is applicable to a resident. There is no special rate applicable to a non-resident. And on the 30% rebate is allowed to a resident and 30% rebate is allowed to a non-resident also. But tax rate continues to be the same for the people.
So there is no difference in terms of resident versus non-resident in terms of investing in real estate.
Yes, there's absolutely no difference on the issues.
I
Now only
think
one concession, as I say, has been given that when as a non-resident you have to sell the property, the resident need not obtain a tenant. The process has been made easier for the resident, which will help non-resident also in selling their property, real estate.
And I assume there is no difference in terms of whether you invest in a commercial property or a residential property. Is that
Yes, there's no difference subject to FEMA regulations, because there are certain restrictions on a non-resident to invest in India in the real estate.
I have a follow-up question on this, Mr. Jain.
Yes, please.
Given the India differentiates between the listed and unlisted securities, and this is particularly for the US investors, like for capital gain taxation with varying holding periods and tax rates, and considering the TDS implications for non-residents, how should US investors evaluate the tax efficiency of investing in publicly traded Indian companies versus the privately held entities?
I will see when you are making an investment in a listed, publicly traded listed securities, you are basically an investor. You are not one of the promoter or something like this. But when you are making an investment in a non-listed security, you are one of the investor with it, not only simply a promoter only. Now, that way, see, what we have done is way back in 2000, we have given a large concession to the listed securities in order to attract foreign investment. At that point of time, India said that whatever is the capital gain arising on a listed security, we are not going to tax it. And in lieu thereof, India levied a small STT, security transaction tax. Because at that time, the capital gain arising was not high. Somewhere in 2014 or 15, I believe 16, the government realized that the people's earning is too high in capital market. I will say normal 7-8%, as against you are making 12-15%. And then naturally the government wanted some share in tax out of that. And then they said, no, nothing doing now. If you make a capital gain, you need to pay me 10% tax. So in addition to STT, that was the idea which was levied out. Now in 2024, the government thought that now our capital gain tax structure has become too complex. Let's simplify it. Across the board, whether listed or non-listed, 12.5%. And in case of a short-term capital gain, in order to just give a relief, they just kept at 20% in respect of a listed. Otherwise, it is normal taxation.
So is there any withholding from the sale of security? For example, if I invest, let's say I buy from a secondary market, the Reliance shares, and I sell it for a gain, is there any withholding from a India perspective?
Yes, it is a withholding taxes applicable.
Okay. The other question with regards to the investment in securities, how significant is the direct PIS access without heavy FPI compliance for US-based professionals wanting to invest in Indian listed companies?
I believe this budget has given one of the best options for that purpose. Because when you allow a ceiling from 5 to 10% portfolio investment without, now you need not go through a broker and you need not follow the process of what we call getting a registration as a FPI, etc. You can simply go and invest. And as I said, GIFT City, International Financial Service Center, gives you the best option as a non-resident. You can go and invest and get a tax-free income there.
That's great. That's very good.
So I have a question on like return filing requirements for NRIs, and I think you have covered it already in your presentation in scale. But like to be very precise, we want to understand that NRIs that earn only interest and dividend income from India, and this is particularly for those NRIs who just earn these incomes, on which TDS is already withheld at source. In such cases, is the filing of income tax return still mandatory, or are there any scenarios where the compliance can be avoided?
See, there are three conditions which we have to look into first. You have interest and dividend. If you have a simple dividend income and tax has been deducted at source, then there is a particular section 115A which says no, you are not required to file the tax returns. That will be sufficient. But if you have an interest income and your income is less than 2,50,000 rupees, then there is no requirement because you have not crossed the threshold also, overall threshold. But the challenge to you will be that tax having been deducted, you will be intending to file the return and get the refund of the tax deducted source. So that's why I did mention in my this that this time budget has allowed you to file online form asking the assessing officer in advance a direction to the bank that no tax should be deducted on my saving bank interest or other interest because my overall income is less than 250,000. So that scenario can be there. But in case you have income about 250,000 rupees, then obviously you are supposed to file a tax return in India. So these are the three different scenarios. I can just repeat, if you have just simple dividend income, whatever may be the amount, and tax has been deducted at source, no need to file a return. If you have income up to 250,000 rupees, you need not file the return.
Mm-hmm.
But if you have income about 250,000 rupees, then you are duty bound to file the return. But fourth scenario is you have income below 250,000 rupees, but still tax has been deducted at source. Then you will be required, you yourself will require to file the return to get the refund of that. And in order to avoid that filing return and getting a refund, now the government says you can file the form online and get a nil certificate of deduction from the assessing officer and that submit to the bank.
It does not make a difference in case what type of income if it is below $250,000. Either it's a business income or rental property or gains or interest, all type of
Yes.
income is covered.
Yeah, all are because obligation to file the tax because you have a threshold exemption up to 250,000 rupees.
And this is for all the NRIs.
And taxable income. It's
And
not the
taxable.
gross income, taxable income.
Correct. So I'm moving on towards now the double taxation avoidance agreement. I mean, a lot of time what happened is that because the US tax on because if you're a US tax resident, the US always tax on a worldwide income. So meaning you earn income in US that is subject to US tax, but at the same time when you have income from outside US, argument like from India, that is sourced in India, that is also taxable into the US as well. But there are cases where you can avoid double taxation by applying the foreign tax credit. That means whatever the taxes you paid in India, that may be creditable in the US tax returns. So there may be difference in cases because of the tax rate difference. US may tax that income at, let's say, 10%. You may have paid 12% in India. So there may be a leakage of 2% in some of the cases. Sometimes the US does not allow dollar for dollar credit as well on a US tax return. Is there any update in terms of double taxation and avoidance agreement? Because the challenge that I see as a professional, because I've been in this profession for more than 20 years and I have been doing this for many, many years. So US has its own sourcing rule where they say that this income is considered US source versus foreign source. One of the area which is still a gray in that case where when I sell the securities in India, that is considered a sale of tangible property. The US law says that that income is sourced to the residence of the taxpayer, meaning if I'm a US resident, that means that income is sourced to my state, to my country, which is US. But India requires to pay tax on a gain that is derived from the sale of the security. So that tax may not be credible in the US under the US tax law. Is there any?
Yeah, go ahead.
Is there any provision that avoids this type of a leakage where you pay tax in India, but at the same time, you do not get credit into the US?
See, India-US treaty is very clear on that aspect. Whatever taxes you have paid in India, and if that income is going to be taxed in US, you are entitled for the tax credit of that issue. Now, in your example, I can just segregate 2-3 issues. One, in case that income is exempt in India, you will still be liable to pay tax in US. Take a case, you have a public provident fund account which is not now allowed, but in case you have any interest income from PPF, etc., which is exempt in India, but still you will be required to pay tax in US. One. Second, in case in India that income get taxed at a rate higher than the rate which is applicable in the US rate, then credit will be allowed only to the extent of the tax rate applicable in US, not beyond that.
Correct.
But in case the tax rate applicable in India is lower than the rate applicable in the US, then you will be allowed full credit, but difference you will have to pay in India. See, in treaty we have to use it is there are certain income which we say resident country has a right to tax global income, but the other contracting state where you are not a resident, he has got a right to tax certain income. Now, you being a resident of US citizen, now and being a non-resident earning income in India, that income shall be deemed to accrue and arise in India. If that be so, then you are supposed to pay tax in India, but you are fully entitled to take credit of that. There may be some procedural hassle, but to my knowledge, I believe US citizens have not faced many challenges on getting credit of the taxes paid in India.
So I have a follow-up question on this, Mr. Jain. Like, and it's from the documentation standpoint. Like, what is the most common mistakes that the US investors make while claiming foreign tax credit for taxes paid in India?
I believe, see, India issues TDS certificate, tax certificate, and I'm privy to some of the tax returns which our office is handling and which US counterparts are also doing on a part. They have not any time pointed out to us that they have not been able to take credit of the tax paid in India on that part. So all that you need is, on the contrary, is that when India issues a tax reduction at source certificate, and there I believe there is a column in the tax return in the US where you have to fill in the exact particular details, and you will get a credit of that taxes.
Okay, so it's like it's very important to have the tax residency certificate and Form 10F to ensure that treaty benefits are not denied.
No, that tax residency certificate, etc., is a different that is applicable for Indian purposes.
Okay.
See, when I am taking a benefit in India, and this filing of form and TRC is requirement of India. This will happen when a person is a non-resident here and resident then that way the benefit is given. See,
Okay.
because now I am getting your question. What your question is? In the case of a non-resident, certain incomes are taxed at a concessional rate. Now, fee for technical services get at 15%, 20%. Dividend income get taxed at a lower rate as compared to tax rate regime. Now, if you are a resident of, say, USA, and you receive a dividend income from India, so India will be charging tax at the rate of 20% on that dividend income. For that purpose, taking the benefit of the treaty, India will insist that you give me a TRC of the USA. And you please upload a form indicating that you are a resident of US on that purpose. That's a compliance only. But tax rate will be applicable, but treaty provides. Frankly speaking, time was not there because I have not gone into many particular nitty-gritties. Earlier, before this budget, there was a large concession available in respect of buyback of share. On buyback of share, Indian government made a law in 2024. Whatever the amount you receive will be deemed to be a dividend. Now, India has entered into a treaty with Hong Kong. We say dividend will be taxed at 5% only. We have a treaty with UAE where say dividend will be taxed at 10%. We have a treaty with Singapore which says dividend will be taxed at 15%. So all those people were very happy, and many companies, multinational companies, which were having 100% subsidiary in India, they repatriated all the accumulated profit outside India of declaring dividend. 5%, 10%, and even buyback of share also. Now, this law is being changed from this year. Again, this budget going back on this buyback scheme. They say no, difference will be treated as a capital gain, and you will be liable long-term or short-term 12.5 or 20%, whatever it is. So that's a bit. But now coming to your questions, Puneet, on that part, it's a form TRC and for uploading of form is the requirement to take the benefit of treaty in India, not in US. In US, you can take the benefit on the basis of the filing the return and credit you get from here.
So I'll put a little bit on that, Mr. Ved Jain. So the treaty works in a such a way where if it is a treaty between US and India, they want to make sure that there is an article called limitation of benefits. That means if the Indian wants to claim a credit as under the treaty, they want to make sure that the origin person is Indian. A lot of times what happens is that company, they set up sometime in Mauritius. The owner of that entity, or maybe they set up company in India. The owner may be the European person. Doesn't mean that they're eligible because just a set up company in India eligible between US-India treaty. They cannot, because the origin of the owner is not India, but the European. So the limitation benefit article, to avoid that manipulation, that treaty, that because you set up company in India, you're not eligible. They need to see who is the owner and whether they are Indian origins.
This is a very larger question, which is now being hotly debated in India after a judgment of the Supreme Court. You may be aware in Tiger Global case, there's a judgment which has come. And for time, see, India has entered into a treaty way back in 1984 with Mauritius, and with a clear intent that investment routing from Mauritius will be exempt from India in capital gain and dividend income, both will be exempt. Knowing fully well, Mauritius is not a developed nation or a rich country which will bring the capital to India. Idea was routing of the capital from any country through Mauritius.
Through Mauritius, yes.
Through Mauritius. And in 2000, just to complete it, in the year 2000, one of the tax officer raised an issue, what you are exactly telling, that gentlemen, you are saying through Mauritius, you are not located in Mauritius. You are really based in somewhere other country. And where are you particular? You don't have an office even in Mauritius. But government of India went out of the way, issued a circular overnight that in case a person has a TRC of Mauritius, we will not raise any question. That circular and judgment thereafter Supreme Court continued to be valid till 2 months back.
Oh, okay.
Tiger Global was in trouble and Delhi High Court said, no, that circular is a valid circular, government policy is like this. But now, unfortunately, Supreme Court has delivered a judgment applying your same reasoning that no, you are not really a Mauritius, your presence is fictitious, you are really an investor from some other country and hence you are not eligible for exemption.
Yeah, that's something. It's a creative idea sometimes people put in place.
I always say this is a change of perception with the peoples who are at the time what they thought and at the time what they are implementing.
Yes, yes. A little bit on gift city as well. What are the benefits for the investment in a gift city? You can talk more about that. Our audience may understand about what are the benefits of to invest through the gift city. Either it could be in a through the businesses or maybe either as an individual investor.
If you set up any unit in gift city, its income is exempt for 20 years out of 25 years. You can have offshore banking unit, you can have a leasing unit, you can have other accounting services, whatever the setup you have in gift city, and all your income arising from the foreign sources will be exempt. No issue. So it is just like a country outside India in that manner only. And now, as I was showing in the slide, now if you want to make an investment through gift city, your money is in dollar, you always keep it in dollar only. Depreciation is not happening. Your bank deposit is also in dollar. Your income is exempt also. Interest, everything exemption is there. So it is just like a country outside India in that manner. So in that you can think about that. An idea probably was just like Singapore. So India wanted to compete with Singapore on that part, and that's why they have created all this scenario on that part.
Right. So I have one question on the new investment vehicles and incentives. Like with the government's increasing focus on attracting global capital and strengthening India's financial ecosystem, has this budget introduced any new investment vehicles or specific incentives to US-based investors? Should actively what the US-based investors should actively consider about these?
Frankly speaking, Punitji, India is moving away from exemption and deductions, not only for US, for all person in India and outside India. Now, if you will see the Indian tax structure, which we call a new regime, clearly says that no exemption, no allowances, even to a salaried employees, house rent allowance, etc., will not be available. So they say that we have given you a threshold of 12 lakh rupees, that's sufficient. Similarly, for corporate, they say that our tax rate is 22% and we will not give you additional benefit, exemption, and deduction. To that extent, even in this budget, they have given an option to certain sector like electricity companies in India, like power generating, distribution, transmission. They have an exemption still continuing on, and there is a MAT applicable. They have given an option that you please exit this exemption regime and get taxed, and we will give you 25% concession till you finish off your earlier tax credit you are having on that account on that basis. So there is no scheme announced in this budget for anyone, including US, that in case you do this, there will be tax exemption. So there is absolutely no such scheme on that part.
Okay, Mr. Jain, there are a couple of questions in the chat. I'll read one of them. Is that what are the tax benefit for investments by NRI in GIFT City? Is the repatriation back in US requires complex compliance procedures?
Absolutely no complex procedure, simple procedure. As you can move out the money from one bank account to another bank account, you can move it like this. And I have been told that people who have been investing, there are many funds which are operating in GIFT City, and they have made a lot of money investment on that basis because they were able to move the money very fast from one area to another area. China to Korea, Korea to Indonesia, Indonesia to India. So they can move the money very fast on that part. So absolutely, there is no. As I said, India is this is going to be a parallel to Singapore only.
Okay. The other question is, how realistic is the fiscal deficit target considering global uncertainty and election year spending pressure?
Can you repeat this question?
How realistic is the fiscal deficit target considering the global uncertainty and election year spending pressure?
See, India is a mass consumption based country with 140 crore population, 1.4 billion populations, mass consumptions. I always say that investment in India is a golden opportunity. Sometimes people do ask whether I can take the risk of investing in India. I always pose a question: can you afford to take a risk of not investing in India? We are such a huge demand. I can give you two examples. I can give you just two examples. In 1982, there were black and white TV in India, and we had Asian Games when colored telecast started in India, and we allowed import of color television by way of a hand baggage. Not a single color TV was available off the shelf right from Tokyo to London. This was the demand which we have created. Now, with such a big demand, now this global uncertainty, hiccups, there can always be hiccups. Now, as you will be seeing my slide, COVID period, that Indian GDP did slip down on that part, but we bounced back like anything. I think one of the best part of the Indian economy has been how we handled the COVID situations. Now, can we believe 2025-26 was not a difficult year? There was headwinds, global headwind. We had some issue on tariff. We had other issues on the challenges. Still, finance minister promised 4.5 and she ended with 4.4. Now she has promised 4.3. See, I believe the economy has been doing very well. And that's why one of the slides, because I was keeping a watch on my timings on that issue. One of the slides which I just wanted to show the scenario which is going to happen in the year 2047, particularly many chartered accountants do ask me, what is our future, having fear about AI and all this technology? I pose a simple question. Today, no economic decision can be taken without the consultation and advisory from a chartered accountant. And today, Indian economy is roughly $4.5 trillion. We are going to project it to be $35 trillion by 2047. Now, 400,000 chartered accountants are managing this $4.5 trillion. Then we will be managing $35 trillion. Look at this, where we are. Indian economy is going to be on the skyrocketing on that part. And one comparison which I wanted to show with the China, it was not an idea that we have lagged behind China. We say the way China has gone from $200 billion to now $20 trillion, India is poised to, in the same ship now, it's poised to grow in the same direction. And we will be not second largest economy by 2047. That's the scenario which is developing in India. So now somebody asked me a question that India will be able to manage the fiscal deficit in 2026-27. I say our numbers are there, and I confirm my number with my tax collections, because that's a fairly good indicator that people are paying taxes only when they are making income and they are doing businesses.
Absolutely. One more question is that insight on any relaxation of for mutual fund investments by NRI or US citizen? Is anything there in the budget?
I don't know. There is anything special on that part. India is trying to promote so far a regulatory regime. We want to promote the bond market, and we want to have some on the issues of the non-debt instrument swap. We are going to allow that issue. That's only a regulatory mechanism, but no tax concession on that part.
Okay, one last question that I'll ask, because I know we are running out of time. OM, place of effective management for the companies, is still on, and is any relaxation on that?
No, it is still on, and Indian tax authorities are serious about it. And I must say they are coming heavily on those companies which are operating from in India, but are registered or located outside India. So my suggestion to all my friends and professionals will be, this matter should be taken effective seriously. The place of effective management continues to be a challenge for revenues here. And what I have seen in the last 1 year, the Income Tax Department has carried out a large search and survey at various places where they have recorded the statement of the concerned person, and he admits that decisions are taken by me or bank account, because now you can remotely operate the bank account, so that can lead to one into very big difficulties. So one need to be very cautious about this one. I don't think US may be having a challenge because both countries are taxable, so there's no issue. This challenge comes up when your company is located in a country which is what we call tax haven or tax conscious.
Yeah, but the point is that happens when a lot of time now companies do business through online. They don't need any presence in the foreign country. For example, companies sitting in India, they want to open up office maybe in Singapore and the US, where they do business online. For example, let's say the travel company like Make My Trip. What they do is they set up company in India, but they do business sitting in India. No, but they don't hire anybody in the foreign country, neither US, maybe other part of the world. In that case, they are required because they created a subsidiary in the foreign jurisdiction, but they don't have anybody there to operate business because everything is controlled through Indian office. In that case, they are supposed to pay tax on the income generated in a foreign jurisdiction, but India does not allow that. Okay, that income subject to taxes in India as well.
I believe that's a challenge which is going to happen with the change of technology. Just to support your view, now tax residency rules in all countries say that if you have been in India for 182 days or more, or you have been, by and large, all countries are saying except USA, which go by citizenship also. Now take a case, if now I can do everything not by physical presence. I can sit in Dubai and just operate my office from there, Dubai, and I can say I'm a non-resident because I am not in India for 1 or 2 days. So I believe looking to the way the technology is changing, the way intangible things are changing, the tax structure over a period has to undergo a change globally.
Correct.
And I believe all these countries, particularly OECD, has to come to and sit together and work out how to divide this cake of tax between the different countries, because there may be different claimant. They say that you are registered here, I will collect tax. You say no, you are operating from here, you will collect taxes. How you are going to settle it out? That way is a larger part. And I believe some, like we see in India, there is a GST council of various states will decide all these issues. So there has to be a world global council on tax council to decide that how this cake of tax is to be divided between the different contender, that which part has been executed in which country and which part has been executed in other country. This is a challenge that is going to happen.
So this is the same challenge that we see in US also, because US has a federal tax. Apart from federal tax, they have a state income tax also. So what happened is that usually in olden days, state used to tax to the companies only when they have physical presence, meaning they have offices, hire employees in the state. For example, if you hire people in New York, New York will tax the companies if because you have physical presence. Now, what happened is that because of these e-commerce businesses, they don't need to hire people everywhere. They just sit in a one state and generate revenue from a different states. The states were starting losing money, saying that I don't see any physical presence, but still they derive a lot of revenue from our state. So they starting implementing different measures where they say, we don't need any physical presence. If you derive a certain amount of income from our state, you'll be subject to tax.
I will suggest two things for that. Because US can be a best guide for others. And India's past history when British India was there. So we used to have two parts, British India and other states. British domain, which we want to call, and ruler state, which you have taken. And tax laws were different, and there were certain exemptions in rural state and not British India. So at that time, the law has developed where income will get taxed. And now in 2016, we have come out, 17, we have come to GST Council. So now the US should constitute a GST Council of all these 50 states and come out with a conclusion that this will be the basis for allocation of the state taxes. This state will be able to tax it. If you look at the Indian history of the sales tax, central sales tax, the law says the state from where the movement of the goods takes place will be liable to pay tax. When the goods moved from Maharashtra to Delhi, 5 states were in between. Every state started asking tax.
Wow.
Then the government constitution was amended way back in 1956, providing that only the state from where the origin of the goods takes place, that will be entitled to collect the tax. Nobody else will be able to collect tax. So some law will be required, constitutional amendment will be required to handle all these issues. Because I see the way business is being conducted, e-commerce, online, the way advisory is being given, the way physical presence is not required. I think all these are the technology changes, and the law has to get changed and get itself adjusted and accommodated on that part.
Has to change. Yes, absolutely. Yeah, absolutely. Thank you so much. Thank you.
Thank you, Devang. Thank you, Puneet. And thank you, CA Ved Jain, for such an excellent discussion. We have us and all the members of the New York and Philly chapter have taken back a lot of value from this discussion, and I hope there's more to come. So, that being said, there was a final question from Praveen Tikmani, which is about upcoming initiatives from the CG, and we are going to spend a few minutes to speak about certain upcoming initiatives by both the New York chapter as well as the Philadelphia chapter. So, Devang and Puneet, you guys can spend 2 to 3 minutes speaking about what to expect in the coming months.
Okay. Puneet, you want to start first?
You can go ahead.
Okay.
Yep.
Okay, I'll talk about a little bit takeaways from this webinar also. The first is I think the government has clearly maintained the balance between growth and the fiscal discipline, continually focusing on infrastructure, manufacturing, and digital transformation. So as a long-term vision rather than short-term measures. The consistency build confidence for the global investors. Companies expanding into India or from investing from India into the US must approach strategy holistically, considering not just the growth, but cross-border tax implications, repatriations, and compliance frameworks. This budget is not about the numbers, I guess. It is about the direction. So for investors, the direction of policy signals continued opportunity in India's growth story. And I think as a professional, our role is to translate that direction into actionable strategy and for investors and the businesses. So before we close, I'd like to sincerely thank you, Mr. Honorable Consul General, Mr. Pradhan. Thank you so much for your continued support in hosting and facilitating such meaningful discussions. We are also deeply grateful, Mr. Ved Jain, for his insightful perspective, valuable contribution to today's discussion. His experience and a thought leadership added tremendous depth in this webinar. We also want to offer our full support to the consulate in its ongoing effort to further strengthen economic, professional, and strategic ties between US and India. As members of this professional community, we stand ready to contribute in any way that helps advance trade, investment, and collaboration between our two nations. I'll also share a few words about what our new chapters and its direction we are moving in. Our focus is on a strong collaboration. So we recently had a couple of events with Philadelphia chapter, but we also collaborate with other US chapters as well. By working together, we are aligning on a shared goals. We can generate greater impact for our members and increase the presence of our professional community across the country. Given the New York is its position as a global hub, our chapter is uniquely placed for strengthening the trade and commerce between US and India. We aim to serve bridge connecting business, investors, and professionals across both jurisdictions. Through knowledge sharing, technical forums, and strategic discussions, we want to support the cross-border growth and responsible economic expansion between two nations. In the coming months, we have planned several events. That is all in the works, but a couple of events is being finalized. One of them will be artificial intelligence. It will be how it is impacting our life professionally and personally, and how we navigate this complex world these days. We also think about the well-being of our members, where we think that yoga and meditation will be an ideal event for them for our well-being of our members. There are more to come, but as the initiative take place, we will be announcing those events. But please stay tuned, stay engaged, and continue to support our chapter, and we build a stronger community in the entire nation. Thank you so much. Again, thank you so much, Mr. Pradhan, and thank you so much, Mr. Ved Jain, and thank you all who is joining this session. Thank you, everyone.
I will share the PPT with you, this station, Mr. Devang. You can share with the participants only.
Amazing.
Sure. Yeah.
Thank you, Devang. So I'm Punit from Philadelphia chapter, and thank you so much, Mr. Ved Jain, and thank you so much, Mr. Pradhan. I sincerely thank you for your continued support and engagement for our professional community. Special thank to Mr. Ved Jain for his special and insightful comprehensive analysis. Your perspective is truly helped bridge policy with the practical impact for our members. We truly appreciate your time and expertise. My key takeaways is that after this session, like on the Indian budget, is one thing is very clear. This is not just number-driven budget; it's a structural signal. India is presenting itself as fiscally disciplined, globally competitive, and increasingly predictable for dollar-based investors. For NRIs and US-based professionals, what I think is we are seeing a real shift towards the ease of investing and trust-based governance. With the rise in GIFT City as a global finance gateway, India is offering growth with greater regulatory and tax certainty. Several sectoral priorities in electronics, critical minerals, clean energy, and digital infrastructure reinforce India's China plus one positioning. I hope so. Overall, this budget suggests that India is not just seeking capital, it's strategically positioning itself to shape global capital flows in a decade ahead. So that's what my take is. And before we conclude, I would like to also take a moment to talk about the exciting direction that the ICI Philadelphia chapter is taking. We are committed to creating not just knowledge sessions, but meaningful community experiences. In the coming months, and Holi is around the corner, so we are definitely planning a vibrant Holi celebration. We are also planning a WHO themed based knowledge event. We will also continue our speaker series, which we did, and we have got a lot of traction in the previous year, where we'll be bringing a lot of industry leaders closer to our members. Our goal is simple: to build a platform that combines professional excellence with strong community engagement. I truly encourage all of you to stay connected, participate actively, and be a part of shaping future of our chapter as well as the ICI US chapter as a whole. Thank you so much. And again, special thanks to Mr. Jain and CGI, Mr. Pradhan.
Thank you. Thank you.
Amazing. Thank you, Devang and Puneet. Those are exciting initiatives. And with that, on behalf of ICI New York and Philadelphia chapter and all the participants here, big thank you, CA Ved Jain. Thanks for your time. Thank you, Ambassador Pradhan. Thank you, Ambassador Raj Lakshmi. And thank you to all the attendees who've joined us today. We firmly believe that this is the first of many more to come. And hopefully, we will see you all at our upcoming events and continue our conversations. Have a wonderful day.
Thank you.
Thank you.
Thank
Thanks.
you.